you, Marty. Appreciate it very much. Good afternoon, everyone. I'm Milton Vescovacci with the firm, law firm Gunster. We're a Florida-based firm. And our next panel is going to be discussing SPACs, as Marty mentioned. With me on the panel are David Boris from Forum Merger 3 and 4 Corporations, Stephen Fletcher from Explorer Advisor and Apex Technology Acquisition Corp, Stephen Cannon from SPAC, Global SPAC Partners, Blake Whitehead from Plum Acquisition Corp 1, Schlussel from IngleSea Capital. Why don't I have David introduce himself, tell us a little bit about himself and his organization and from what perspective of the SPAC world he's coming from, and then follow that by Stephen Fletcher, Stephen Cannon, and then Clay and Irv. Go ahead.
Great,
David.
thanks. Can you hear me? Am I good?
You're good.
Thanks. Yeah. You never know when you're the first speaker whether the microphones are on. So thanks for having me. It's a pleasure to speak with everybody. So I'm David Boris. I am the co-CEO of currently of Forum Merger 3 and Forum Merger 4. We are a generalist SPAC. My background is investment banking. I started out 20-something years ago totally by accident, of course. Ended up working on some of the earliest SPACs. Thought it was really interesting and hung around whenever I had an opportunity to work with a client on any side of a SPAC. So fast forward, as a banker, I worked on 25 SPAC transactions, either on the IPO side or the M&A side or advising a board or a family office or what have you. And so finally in 2017, decided to go out with my partner, Marshall Keefe, and we launched what was Forum Merger 1. And we completed an acquisition, said that was fun, and our investors all made money. And so we flipped around and did Forum Merger 2, acquired a business or merged with a business called Tattooed Chef, which is listed on the NASDAQ. Forum Merger 3 has announced a business combination in the electric truck space for electric last mile solutions. And Forum Merger 4 went public just last month. We're a $300 million generalist SPAC looking for another exciting private company that wants to be public by merging. And that's us.
Thank you, David. Stephen Fletcher.
Hey, everybody. Thanks, everybody, for joining us here. As Milton said, I'm Steve Fletcher. My background, similar to David, I was also an investment banker for over 20 years. Most of that time at Goldman Sachs. And 3 years ago, I left banking and started a firm called Explorer, where we sponsor a series of SPACs, each one in partnership with A-plus caliber former public company CEOs. And we have done 5 SPAC IPOs so far. We've de-SPAC'd 1 and are in the middle of de-SPACing a second. 3 are currently searching for merger partners, and we have 8 or 10 more in the planning stages for IPO for this year. So hopefully have a good amount of SPAC market expertise to share with the group here.
Thank you, Stephen. Stephen Cannon.
Thank you. So this is going to be a little repetitive. I too am an investment banker for a couple of decades. I stumbled on SPACs back in 2004 as a banker. After doing a few advisory assignments, a few underwriting assignments, I raised my first SPAC in 2008 as a principal. I too have done several SPACs, 8 so far. And we too also have 3 live SPACs at the moment. Our platform is called SPAC Partners, but we typically partner with different groups for each SPAC that we raise, and we build their brand in the SPAC market. So the other thing to mention, I think we'll talk about a little later, is most of the SPACs I've done have been international SPACs, and I think that's one place thus far where it's still not sort of over saturated with SPACs. And then there's some very interesting developments happening, especially in Asia at the moment.
Okay, great. Thank you, Stephen. Clay Whitehead.
I get to break the chain here. Non-banker, come from a venture background and an operating background, and that's really the genesis of Plum. We are for operators by operators. We're a team of 48 operators, all dedicated to finding an extremely high quality company and helping them go public and succeed in the aftermarket. And looking forward to talking about this topic more.
Great. Thank you, Clay. Irving Schlussel.
Hi, everybody. I am with a large family office in South Florida called Diamond Family Office. Recently announced that role yesterday, leaving IngleSea. So it's kind of an exciting change for myself. My approach to SPACs is an investor arbitrageur. And, we're very focused on owning the warrants and the share in particular as a yield to maturity play with an embedded option. Obviously, we're also focused on the quality of the sponsor team, et cetera, but we really look at the SPAC dynamics and the price and what our yield could be. Been investing in SPACs for about 10 years, and obviously following the events of the past 6 months where issuance has gone up by maybe 15 times has been pretty interesting from my seat.
Thank you, Irving. So there's actually one other member of the panel. He'll be joining us later. We'll introduce him in a little while when he joins. So as Marty mentioned, the SPAC world is on fire. I mean, this year alone, there have been over 200 SPACs that have gone public. 300 and change are chasing targets. Why don't you, David, Boris, tell us what a SPAC is? Give us some idea as to what the features are, and what are some of the advantages and disadvantages of doing a SPAC? Just give us the basic one-on-one.
Sure.
Everybody's on the same page.
Yeah, sure. Yeah, and thanks for the softball question. That's an easy one. So yeah, sort of to level set the group here. So a SPAC is a special purpose acquisition company. It is a publicly traded company usually, and I'm only speaking for the U.S. because there are experts here that are non-U.S. and I'm anxious to learn more. But it's a publicly traded company on usually the New York or the stock exchange or the NASDAQ, which is designed to go out and find a private company most of the time that wants to merge with it. And by merging the public company with the private company, you end up with a new publicly listed company, avoiding the traditional IPO path. I think probably an easy way to look at this is there's, let's just say, 3 legs to the SPAC stool. You have SPAC sponsors, which are some of us on this panel, which go out and form a SPAC, put up the risk capital to do so, spend their time and energy and money, and then go out and try to find this private company and negotiate a transaction that's going to be exciting for Wall Street. And what's in it for us is, in exchange for putting up our capital and our time, we end up with what's called founder shares. So we end up with a bunch of equity in the public company at a discounted price. Then you have the public investors who buy the SPAC. And why do they do that? They do it because when you buy a SPAC IPO, you get a unit, and a unit consists of a share and some portion of a warrant, and that's backed by this trust account. So there's basically a put option. So it allows public investors to invest in a SPAC management team, which has unlimited upside. There's been some amazing success stories in SPACs, but also has downside protection in this trust account and this embedded put option that was discussed by Irving. And then the third leg of the stool basically are the companies that choose to go public by merging with the SPAC, and they do so because they think it's faster, maybe more certain, maybe there's certain economics that they can get with a SPAC transaction that's hard to get in a traditional IPO. So you put the public market together that's looking to invest in these companies that want to go public, backed by a SPAC sponsor, and that's essentially the principal players in the SPAC ecosystem. And then there's a lot of lawyers and accountants and bankers that all make it work. But those are sort of the 3 main groups that keep the market moving.
Yeah, and to tell us about the advantages of doing a SPAC versus a traditional IPO. Any one of the panelists can chime in. Go ahead, David.
I'll just start, and then anybody else can kick it off. So there's a few. I mean, one is the SPAC is done and the money is already raised. So a SPAC merger is a merger, as opposed to an IPO, which has a sort of price discovery component to it, right? We've all seen lots of transactions where an IPO gets upsized or downsized and such right at the last minute. So in a SPAC merger, the SPAC sponsor and the target company negotiate a business combination. They set the valuation, and if you do it all right, there's more certainty in that valuation for the target company than there is in the public. And in addition, a SPAC merger very often has some cash distribution out to the founding shareholders at the start, if they're a private equity fund or a family office or what have you. And that's much, much harder to do in a traditional IPO.
Okay. So Irving, I know that you're looking at it from not the sponsor's point of view as David is, but from an investor's point of view. What interests investors in investing in SPACs?
Well, there are different approaches. So there are investors who might own a SPAC through the event, the merger and the effective de-SPACing, who have a genuine view that they want to be invested in this company. So my approach, and I think the traditional holder base of SPACs has a relatively different approach, where they are essentially lending capital to the sponsors with the optionality that comes with it. So you get your cash in trust, and then you have the upside that if there's a good deal and somebody else thinks it's a good deal, you could sell it to them upon the de-SPACing at a premium. And up until, say, 7-8 months ago, that rarely happened. It happened, but it probably wasn't the base case. So your average SPAC that I owned would be, I would buy the unit, strip the warrant, sell the warrant, sometimes keep it if I really like the sponsor team, and then I'd put the shares back upon the de-SPACing. And more times than not, I would be putting the shares back.
Okay, Clay, you approach the SPAC world from an operator's perspective. What makes that different than your traditional SPAC sponsor who's maybe not been an operator? Is more a financial sort of person like some of the bankers that are on the panel.
Yeah, I mean, look, so I advised several very successful companies, been invested in several very successful companies, and ran my own growth company for a decade. And what I've seen time and time again, whether it's with SPAC pitches from investors or just general pitches to invest money in a private company, is that more often than not, they're missing the mark when they're approaching the company. They're viewing it as a financial transaction. They're not sitting down to understand the business. They're not thinking about it as a long-term partnership. And they're not approaching it in a way that helps the CEO and the management team get comfort that the investor really understands that this company is their baby. And they care deeply about what happens to it. And that can't just be something that's lip service. You really have to be able to dig in with the company, help the company, support the company if you're going to take that type of approach. And so that's what we've done in creating a larger team and really being there for companies and signaling our support for them.
Okay, great. Steve, can you tell us about your SPAC and your particular target that you're in the process of merging with? AvePoint, I believe, is the name of the company.
Yeah, absolutely, Milton. Thanks. So as I mentioned, our SPACs, we do each one in partnership with former public company executives. So that SPAC is Apex Technology Acquisition Corp. That one's in partnership with Jeff Epstein, who was the CFO of Oracle, and Brad Koenig, who was the longtime head of tech banking at Goldman Sachs. And we've announced a merger with AvePoint, which is a data management software company, or SaaS company, I should say. And I think this is particularly notable in that this is the first high growth SaaS company to go public through a SPAC merger as opposed to an IPO. So we're really excited about this. In contrast to many of the companies that go public through SPACs, which are pre-revenue or early revenue. This is a company that's a very stable business, approximately $200 million in revenue this year, growing at 30% a year, and it's a traditional SaaS company. So I think it's great for the SPAC market, and it's a really great company. So we're very excited about it.
Yeah, Steve, follow up on that. Tell us what made the target interested in the SPAC. I mean, what was the sort of the convincing point of view for them?
Good question. And I'll start by saying we prefer to use the term partner rather than target. because we don't think of them as a target. We think of them as a partner, I think, which is similar to what Clay was saying. So we go into this with a very long-term perspective that this is not about completing a transaction. This is about forming a long-term partnership to help the company thrive as a public company, not just complete the de-SPAC transaction. And so the idea of partnering with my firm Explorer, who's done a number of SPAC transactions and really knows how to structure these in conjunction with our partners, Jeff Epstein and Brad Koenig, who are, arguably Silicon Valley royalty, to really help the company, as I say, thrive as a public company. I think that was really the difference. And then when you add to that a couple of the things that I think make SPACs really competitive with product, with IPOs, it's faster than an IPO. And you get to share projections, which I think is important for growth companies. And then maybe most importantly, particularly for tech companies, which is where we spend the bulk of our time, as I think most people have seen, tech IPOs tend to go up 50, 60, 80% on the first day. We try to structure our de-SPAC transactions so that there's approximately a 20% discount, maybe a 25% discount to where we think the company will trade as a public company. So the company really gets to have a higher valuation, the same exact valuation post-transaction, but they get more shares pre-transaction relative to an IPO. So I think they chose us because of the team and the partnership approach, and they chose a SPAC for the reasons that David and Clay and Irv and you all hit on, as well as the ones I touched on.
Thank you, Steve. Steve Cannon, your perspective is a little different, considering your SPAC was formed in the Caymans. Tell us about the international market and the phenomenon of the SPACs taking the world by storm. I mean, most of the deals have been done here in the U.S., but it's something that's happening outside the U.S. as well.
Yeah, so actually 6 of my 8 SPACs have been in what I refer to as international SPACs. 2 of the 3 that we currently have live and searching for targets are U.S. focused. Similar themes, similar strategies as you heard from the other panelists. But specifically with respect to international, it's been a checkered history until recently. There were a whole number of China deals that were done in the late or in the 2000s. I like to credit those deals with really having sort of changed the use of the SPAC from, what was originally envisioned as an acquisition vehicle to what it is known as today, a reverse merger vehicle. You've also had sort of really limited history in some local markets such as Germany and Italy. You had some high profile flameouts in London about a decade ago. There's a tax structural problem in London that does not allow you to return the capital on a tax-free basis. But very recently, a number of the global competitive exchanges have been feeling the pressure given what's happening in the US. So now London is actually talking about changing regulations to make SPACs more amenable. But of particular note out in Asia, both Hong Kong and Singapore are moving very quickly. This is in response to a couple of things that have happened. You had the 2 wealthiest families in Hong Kong, both sponsor SPACs. That sort of gets the attention over here. And, just in Singapore, you had the largest SPAC transaction ever announced out of Southeast Asia, a company called Grab, a $50 billion transaction. So, Singapore is trying to beat Hong Kong. They both stated that by the end of this year, they will allow SPAC IPOs on their markets. Singapore just published, the regulators just published a piece at the end of March. I think the international SPACs are ones to keep your eyes on. Both Hong Kong and Singapore say that they are improving the regulatory environment, try and provide some of the protections that it seems the SEC now is waking up to. But also, I think what the dynamic you have, and I should just pause here and say, the last merger we closed was an energy business in the United Arab Emirates, a strategic energy infrastructure called Bruges Energy. And it was owned by the royal family of the United Arab Emirates. That company had been undergoing a listing in London, which was the historical sort of destination from companies that part of the world. And they had been, undergoing the process for over a year before they finally abandoned it and went the route of SPAC. Just final point is, as difficult as it is for companies to go public in the US, it's even more difficult for international companies. So when you have high quality companies like Grab and some other companies that are being rumored out here in Asia to be exploring SPACs, they do so because SPACs are even, even more beneficial to companies in that part of the world than even the US. I'll pause there for now. Could go on, but I'll pause.
Thank you very much, Steve. David, Boris, tell us how you identify the partners, as Steve Fletcher mentioned. Those companies that you're interested in doing deep dive. What are the sort of the characteristics that you're looking for?
So there's a lot of routes to getting to a merger partner, and we totally agree with Steve. We call our company Forum Merger Corp, not Forum Acquisition, and we don't think we're acquiring anybody. We think we're merging and helping them grow and letting our shareholders profit from that. So I think you see a lot of similarity in that aspect here on this panel. So there's a lot of routes in which SPAC founders find various merger partners. There's this phenomenon that has now grown called a SPAC off, where investment banks have a client that has decided that going public via a SPAC makes the most sense for them. So they've already crossed that bridge. They want to be public. They understand the benefit of SPACs. And now that there's so many SPACs out there, they retain an investment bank to sort of help guide them through and say, who are the ones that would make sense based on reputation, track record, industry expertise, whatever is important to that company. I would bet that everybody on this panel will say the same thing, which is we all try to stay out of SPAC off because we want to be perceived as more than a pile of money sitting in a trust account earning 0% interest. And so, we think we add some value to our partners. And so, we've been fortunate that every transaction we've been in has been proprietary. It's been a company that we've known. I was on Wall Street for 30 years. My partner was in private equity and family office for 25 years. And we hit our contacts every day and look for, just a great company. And knock on wood, so far we've been successful. But there's the traditional route through bankers, then there's the proprietary route through all the relationships that we've all developed over the years of our previous careers before becoming SPAC sponsors.
Just to follow up on that, David, so tell us about how you approach due diligence. There have been cases where the SPAC transaction was done in a very abbreviated time frame. Diligence was sacrificed. Tell us about things regarding due diligence and how you ensure you protect.
Yeah, sure. So, I guess I've heard those same stories, and the SEC has recently come out with a number of comments, but the one that relates to what you're talking about is, that there's been some position papers about, SPAC shouldn't be perceived to be an easy way to get public, and there should be the same level of scrutiny. And it was shocking to me because, I didn't know that they weren't. So, we use the same bankers and the same lawyers and the same accounting firms and, the same experts to do the diligence that major private equity firms do. We take it as seriously as any IPO. I can tell you, as a banker, I worked on a lot of IPOs and a lot of private equity deals, and we do what they did. So it was surprising to me that people feel it's a shortcut. It's not a shortcut. If you're a SPAC manager and you're talking to a company that thinks it's a shortcut, I would say run, don't walk away from them. And if you are a company that thinks you can get public through a SPAC because you're not good enough to get public any other way, I would say don't try it. It's a very sophisticated market, and your deal's either not going to get approved or it's not going to trade well, even if you find a SPAC that, you know, is sort of willing to play ball with you. So to me, it's an alternate route to going public. It's not an easier route. It may be faster, it may be more certain, but it's not a whole lot easier.
And Irving, tell us from the investor perspective, what are some of the misconceptions about SPACs? I know that you've written some public articles about the bubble. Tell us a little bit about your sentiment, looking at it from the investor perspective.
Well, you know, prior to about 8 months ago, the SPAC market was, you know, a tenth or smaller of the current size. And you need to ask yourself the question, why is it that we're having this massive growth in SPACs? And, you know, one argument is that it's a more traditional route to go public, less required disclosure. And I think we're seeing a lot of those things fall down. I think the real reason is kind of captured in the performance of three names, which were largely a retail phenomenon, which is Virgin Galactic, Nikola, and DraftKings, all of which did well. And, you know, some of those might be good businesses, maybe not. Certainly DraftKings is, I think, a very real business. But that has kind of led to this phenomenon of a SPAC. And a really important thing to look at is, where is the share price trading prior to the de-SPAC? 2 months ago, there was an unprecedented premium. So, you know, the IPO would come at 10, you can strip the warrant, and the share was trading at probably an average of $11+ dollars. That's unprecedented. That's saying that every deal is going to get done. Because if I'm an arbitrageur, I'm just going to sell it if I don't want to participate in the deal. I'll just let somebody who believes in the deal buy it. And that means that the cash is going to remain in the deal. And the cash remaining in the deal is really the bait that drives all the sponsors, because that's the critical point. If there's no cash that's staying in the deal, what does the shell or the SPAC shell really provide to the acquired company? And it's very little. It's just the shell and, you know, perhaps expertise. I'm not saying that the sponsors on this panel, I think they, you know, have some clear value-added expertise, but given the clear proliferation and the number of sponsors bringing SPAC equity, to me, it kind of leads to the conclusion that a lot of these guys aren't going to get deals done. And the deals that have happened over the past month or two have had pipes attached to them. So when the deal happens, there's a required minimum cash in the merger agreement. If that cash is brought to the deal, then the sponsor could invest most of his shares or whatever subsequent agreement he had at the point of acquisition. So those deals with the pipes will get done, but you're seeing a lot of the recently announced deals now trade well below 10. So you had a point where they were trading at, let's call it 11.50, implying that every deal is going to get done. So now we're at a much more rational point that's in line with historical standards. I'd say on average, you know, SPACs probably provide over the past 3 years, other than the last 6 months, a 2% yield to maturity for holders. And that's kind of where we are right now. But the fact that let's take FRX, the Shaquille O'Neal, Shaq equals SPAC, must be interesting. That deal's trading, I think, at like 990-ish right now for the share. So that's implying that if I'm in it, I'm just going to take my 1003 and cash out. So you have to ask the question, are all those investors going to stay in? And if not, is that deal going to get done? In the case of that deal, the answer is probably yes, because they have a pipe and the minimum cash will be met. But what that implies for the marketplace on a go-forward basis is that the deals that haven't announced are not less likely to get pipes, and then the game kind of classes on itself. So an important statistic, and I'll just leave you with this final point, is prior to this boom, 60% of the dollars in SPACs were cashed out by arbitrageurs like myself. And in that scenario, the sponsor economics were whittled down dramatically, and we might be at a point where the sponsors don't actually get the deals done.
Hey, Irving, can I just jump in here? Sorry about that, Milton. Just one quick second. Can you take just like a 1 or 2 minute deeper dive into pipes and, you know, what that means? I mean, you said that underpriced SPAC that doesn't have a pipe follow-on is not going to succeed. Can you kind of like lay out some counsels for our audience?
And some of the other panelists might have a more informed view on this, because I'm not on the banking side. So, you know, I've gone through the merger agreements, but PIPE stands for a private investment in public equity. And typically, you know, PIPE, you know, I know PIPEs not to be associated with SPACs. It was a way for a company to raise money at a discount and on a non-broadly marketed basis. You know, the banker would go out and raise the cash for the PIPE. Let's say in the recent advent of SPAC PIPEs, almost every SPAC that brings a deal will do a deal that's a multiple of the size of the cash in the SPAC. So let's say the SPAC has 400 million of cash in trust. Maybe they'll acquire a company at a valuation of 1.1 billion, or the recent Korean deal, I forgot the picture, but that was a huge multiple of the actual cash in the SPAC. So that's a scenario where the SPAC is really just a vehicle. And if there's an associated PIPE, so let's say it has 400 million of cash, they might bring a PIPE, private investment public equity, usually struck around 10, although, Loomis had a $15 strike price, so it depends on the prevailing price in the market. And a number of private investors will come together in an overnight deal because they believe in that SPAC, they believe in the company, and they'll agree to participate. And then where it gets trickier or important, when that deal's being closed just prior to the PIPE, the SPAC sponsor will cut a deal with the acquiree that says, this deal will occur per either our original economics of sponsor promote or any new agreement that they have, assuming I bring a minimum dollars of cash to the table. So let's say, for instance, the FRX deal, it's implying right now that investors aren't going to participate. Investors, that deal will still happen. I don't know the size of the PIPE there, but there's likely enough dollars in the PIPE that the minimum cash will be met, even if all of the ARBs in the SPAC share cash out.
Yeah, Stephen Fletcher, if you don't mind, you had mentioned earlier about treating the de-SPAC transaction as a partnership. Tell us about, how do you ensure the credibility of the sponsor so that, it can identify a potential partner first. Second of all, and be successful at achieving that transaction. And thirdly, avoid having all the sort of, the negative, review sentiments about what's happening today with the bubble perception that Irving has.
Good question. So it's really about the resumes of the people in the sponsor and the experience of the people in the sponsor. And so, as I said, we at Explorer always try and partner with people with pristine resumes who've been CEOs of big public companies before and are really value add board members post de-SPAC and can really help the company thrive post de-SPAC. And we combine that with our experience to really help the company thrive. And so it's really about history because ultimately that's what the companies have to go on is who are you and what's your relationship with that company from beforehand and what's your resume from beforehand.
Okay, Clay, can you tell us about some of the trends?
Hey, Milt, can you hold on a second? Fred Nazem, are you there? Did you have a question, Fred?
Yeah, I do. This is Fred Nazem. I was wondering, there is always this talk of adding value by sponsoring it. What are those values really in reality? And how could you really help an operating company strategically located going very well? I have a couple of companies that people are sought after for SPACs, and they keep telling me, they're strategic partners. What does that mean?
And for those of you who don't know Fred's an old school VC. He's taken 70 companies public in the past. So, Fred.
Yeah, so Fred, this is Steve Fletcher. Let me give you a concrete example. So our first de-SPAC, our partners were Lloyd Carney and Eric Benamou. Lloyd was the CEO of Brocade, which he sold to Broadcom for $6.5 billion before partnering with us. He's also the chairman of Nuance, which just got sold to Microsoft for $20 billion, on the board of Visa, on the board of another number of large companies. And Eric Benamou, who had been the CEO of 3Com and Plum.
I know Eric, yeah.
He can say the internet if you need to.
So Lloyd went on the board as non-executive chairman. Eric went on the board as well. And while they're not day-to-day management, they work extremely closely with the management team. And so Lloyd spends about half a day a week, 4 or 5 hours a week, working with the company to help them with everything that goes into the business. What's the strategy? How do they go after customers? What should the HR plan be? What should the verticalization strategy be? Really digging in, and you get somebody who's CEO or chairman of many multi-billion dollar companies, working very closely with the CEO who's never been CEO of a public company before. And so when I say value add, it's really digging in and working very closely with the company.
Yeah.
Thank you.
Okay, Clay, can you talk to us about some trends that you're seeing in the SPAC world?
Yeah, I mean, I think two trends that I'm seeing are one, which is this value add, which I'll just comment on. I mean, very similar approach to Steve. You know, collectively, our teams created 420 billion in EV as operators, so we definitely have the experience. And one thing we've done that's different is we've segmented out all the different ways we think we can specifically help a company. Everything from leveraging DEI, well, great. If you need help there, Ursula Burns is our executive chairwoman. If you're an enterprise company and you're looking to expand, not only did Ursula run the was vice chair of the Business Roundtable, Declan Kelly, CEO of Teneo, is an investor and advisor as well. So we can get Fortune 500 CEO very quickly, and so on for international growth and other common things that whatever the need is, we've paired it with a specific executive who's had outsized success in the public markets in just that area. So people get a band of advisors and experts with Plum. I think in terms of trends, I'll highlight two. One that I like and I think is positive in both a social sense and a business sense is an increased focus on diversity, equity, and inclusion. Pretty much every high growth public company, private company is wrestling with this in the boardroom. And I think a lot of SPACs are taking a positive approach to diversifying themselves and to offering diverse board candidates to the successor company. And many of them, including us, are taking pledges to put some of their economics on the table for DEI related causes. And then the second thing I'd highlight is just, again, this operator driven model. We're going to see more of that, and concurrent with that, we're also going to see more verticalization and specialization of SPACs, because what really helps at the end of the day, what really can create a lot of value is the subject matter expertise and the personal and professional relationships of that SPAC team. So I think we'll see further specialization in the market for that reason.
Great. David Weisburd just joined. Follow up on the trends and opportunities. Talk about what you see in terms of opportunities in SPAC.
Yeah, I mean, we've seen, we've been preparing for what's going on right now. We thought this would come in 2022, frankly, the bifurcation of the asset class in terms of, you know, tier one sponsors and everybody else. And we see this over and over. You know, David Boris talked about SPAC off. It's certainly happening, but what's really interesting about the SPAC offs is that most of the SPAC offs end up with one winner, and a lot of times none of the promote is given up. And people wonder, how could that possibly be happening if it's a SPAC off? And the answer is because it's a very significant gulf between tier one sponsors and others in terms of a very important part, which is execution and the pipe. So making sure that you get the pipe. In fact, one thing that tier one sponsors are able to do in difficult kind of environments like right now is that they could set it up in a way that the pipe is at or near the minimum cash to close on the transaction. So if you see what's going on in the market today, the transaction still has a very good shot to close, despite kind of, you know, everybody's running around with their head chopped off on the streets. So I think we're going to continue to see that. I think we're going to see, you know, right now, and I guess the last 30 years, generalist SPACs have really done well. I think we're going to continue to see that, but also I think we're going to get a niche down on the strategy. We're going to see some, you know, somebody like the Coens with the FTAC and the, you know, Insurance Acquisition Corp, those kind of franchises, but also, you know, there might be a media SPAC, there might be a, you know, CPG SPAC, and obviously it's already happened, but I think we're going to continue to see more niching down and more focus on value add and execution.
That's an interesting point you make, because one of my questions to follow up was, you know, have SPACs not ventured into certain industries? Are they staying away from certain industries? Or anybody wants to comment on that? Steve Cannon? You're up.
You know, historically, it was difficult to make SPACs work with really asset-heavy industries because, you know, of the discount that was required, you know, in arbitraging the value of the business for the public investors. It seems like, you know, I used to say a few years ago, you know, since I've been doing this for quite a while now, I used to say that, you know, you had to have a real business with real revenues, but I was proven wrong this last year. But I think there's going to be some, some laws of gravity that return to what's a suitable target. I think the other thing that was kind of missed was, are companies really ready to go public? I heard a lot of stories about, companies agreeing to merge with SPACs and not even having CFOs, for instance. So our strategy echoes a lot of what you already heard from other folks. We partner with very experienced senior executives in our SPACs. And we believe in the differentiation model as well. We tend to focus our SPACs on specific verticals as opposed to being a generalist. One other comment I would add is the question about what's been driving SPACs. I sort of lay the blame on the investment banks to a certain extent. It seems like there's been a real lack of real screening as to who's appropriate to be sponsors and who's not. You're just now reading LPs in PE funds starting to question those PE funds, whether or not, they're being paid heavy management fees to go off and, do SPACs. And so hopefully there'll be a little bit more rationalization. But, you read about Citigroup's, earnings this quarter, and they said that it was the record earnings were driven by SPACs. And when you look at the fees that these banks are taking out of SPACs, they make more money off raising the SPAC, being financial advisor on the transaction, and raising a PIPE than they ever would have made on the IPO. So it's been a little bit of a feeding frenzy, and that's also led to the excess proliferation of SPACs, in my opinion. So hopefully that'll be rationalized.
We have a question from the audience. Jeffrey Wu asked, under what circumstances should an investor pay a premium for the SPAC over $10, the initial value? Given that they are initially blank check companies, it seems the premium is purely speculative. David Boris?
Well, I probably have a different opinion here than Irv, so who would probably say you should never pay a premium, right? Because he's an arbitrator, and that's one thing. So look, there's two answers. One, so you divide the world into before the deal is announced and after the deal is announced, right? So a SPAC goes public, they don't have a deal. You can say, all right, look, I just got this share in this warrant. The share is worth $10. The warrant's worth $1. So let's just say it's worth all as a bucket, $11. But I think Clay is going to go off and do a great deal, and so I'm willing to pay $11.50 for that unit because I think there's some value to what David or Weisburd or Clay Whitehead's working on. So that's one, right? So you pre-announcement, you can just say, look, I'm stopped out at what I can lose by the trust account, but I'm willing to invest a little bit more knowing I have that cushion. Then there's the SPAC announces a business combination, and because SPACs are public companies, our business combinations have to go through the SEC, and there's a proxy period and there's a shareholder meeting. So there's months that happen from when the deal gets announced to when the deal closes. And at that point, the SPAC really trades more like the public company, not like a SPAC anymore. And so investors can say, look, I really like this SPAC. The deal is going to close. I feel comfortable, and I'm going to invest in this SPAC. Now that they've announced that they're merging with XYZ Corp, I think XYZ is really interesting. So at one point there could be a premium and at one point not, but those are sort of two different investment decisions you make.
Okay, we have Rob Collarina who wants to ask a question.
Hey, thanks, Milton. Can you hear me okay?
Yes.
Okay, great. I put something in the box there, and it was with respect to the WeWork SPAC. I think that number is like a $9 billion number. And I guess question-wise, was it too big to fail? The fact that SoftBank, is such a major player in technology and with the LP structure around that, they had sort of unique competitive advantage, towards this valuation, given where it was, or was there feeling that the operation itself sustained and sustained the value coming out of COVID? So I'd be curious as to some panel input on that. David
Weisburd, do you want to answer that?
Yeah, it's a tricky question. My day job or my second job is in venture capital. SoftBank is here to stay in many different ways. They've just launched several other kind of vehicles. I think rightfully so. The market you know, kind of looked at it as, you know, you have $100 billion or, you know, the gravitas of SoftBank behind the deal. So I don't think it's a kind of, it's a non authentic signal. I think it's a real signal in terms of, you know, whether the deal is going to close and whether it's going to be successful. So I think that is, you know, if it was another backer and another company, it might have been very differently, but I think it's legitimately a good consideration when you look at who's backing it, just like you would look at who's backing a pipe in a regular SPAC as well, or in a different SPAC. So I think it certainly helped them a lot to have SoftBank's backing, both in the company as well as in the pipe.
Any other panelists want to chime in?
Yeah, I'll add on to that. I certainly agree with everything David said. I also think just from a market standpoint, investors have been particularly focused, not just for SPACs, but broadly speaking, on companies that are going to come out of the pandemic with a lot of momentum, you know, that saw downturns, and now we're going to see a real upswing. And WeWork has to be one of the hardest hit companies in the pandemic. You know, short-term leases, everybody got out of their short-term leases, but as the world starts to return to normal, they should see a massive reacceleration in their business. And I think the market wants to believe in those kinds of stories, whether they're restaurants or airlines or cruise ships or hotels or WeWork.
Hey, Steve Cannon, can you tell us what you think are the tools necessary to ensure a successful SPAC IPO?
SPAC IPO, you mean of the SPAC when SPAC IPOs?
The SPAC IPO and then the follow-on de-SPAC transaction. Like, what are the fundamental things that have to be in place?
Yeah, well, I guess I like to use an anecdote to illustrate what doesn't work. Some people may have missed it, but back in February, there was a SPAC that filed with the SEC to go public. And literally the name of the SPAC was Just Another SPAC. Some of you are nodding your head, so you must have seen it. You know, obviously that's somebody who doesn't take serious what we're doing and what we're talking about. And I think that is endemic of the market. I mean, I think a lot of people just sort of looked at it as free money and free for all and whatever. And a lot of those people are going to have rude awakenings now that the SEC is really starting to enforce stuff like no pre-identifying targets, you know, really whether conflicts of interest are vetted, whether due diligence was done at all. You know, we take a similar approach to David and Steve and the other panelists in that, you know, we take all that stuff absolutely seriously. So what does it take to be a success? Well, we IPO'd our most recent SPAC, global SPAC, 2 weeks ago. This was supposedly the IPO market was dead. I don't know if people paid much attention, but there was 20, 30 SPACs a day IPOing and it went to zero because of some of these SEC announcements. We still priced our SPAC when no SPACs were IPOing because we have a reputation, a relationship with investors on Wall Street, specifically the SPAC funds, what I like to call the dedicated SPAC funds. So I think to get a SPAC IPO'd, you have to be serious. That's one. Two, you do have to have requisite skill sets. But I think, you know, just checking one box isn't enough anymore. I think like the other panelists said, we try and assemble teams where we check multiple boxes, right? I like to say that I partner with vertical experts or geographic experts, and then we've got the SPAC covered or the SPAC mechanics covered. But that's for the SPAC IPO. I think in the interest of time, I'll just stop there unless you do want me to cover the other point.
Clay, you might want to talk about success, ensuring success. What are the tools you need for a de-SPAC transaction?
Well, look, I think there's a lot there. I would defer to the people. We're in our search phase, so I'd be most interested in hearing from panelists that are going through one live or have been through one before. David, Steve, when we want to take this?
I can. We've de-SPAC'd 2.5 at this point as principal. So I think it is transitioning the investor base. As Irv was mentioning, there's a lot of SPAC arbitrageurs who aren't really that interested in what the business combination is, right? They're in it for a different reason, which is totally fine. It makes the world go around. But we need to take investors who were in it for the arbitrage and help them get out of those shares should they choose to, and then get it into long only hands or natural buyers who are excited about supporting the new company long term. There's other things like getting equity research lined up so that when the company comes out as a public company, it's not orphaned with no equity research and analyst support. So you want that newly formed company to have, to be interviewed on CNBC and Bloomberg and such. And you want them to be invited to industry conferences and be respected and covered by respected analysts and all the things that happen sort of behind the scenes. Another value add, I would say, that SPAC sponsors that think about these things, try to help their companies with, because a lot of these companies are new to that as newly public companies.
Okay, great. I think we have run out of time. Marty, do we have any more time or?
Milt, I've asked you 2 other questions. If you can just give them
feel free.
a minute each, that'd be great.
Go ahead.
So, so my first question is, can you guys provide some data on how many SPACs are out there right now looking for targets? Is there more than 200?
Yeah, there's closer to 400.
70, yeah. Yeah. You said 400, Steve?
Yeah.
And what's the parameters of your target? What's an ideal target versus, and I'm just like, thumb in the air, sort of looking at the wind, what's the ideal target and what's the plus minus or over under on that target? Like how dirty of a target will you guys take, et cetera?
Look, I think everyone's got different criteria for their targets. I think in this market, both because of who we all are and how we approach the SPAC market, it sounds like, and also what the market is demanding, we are looking for companies that speak for themselves in terms of quality, with the capacity to compound over the long haul in the public markets. And so if I give you one criteria, it is that, and we should all be focused there.
Okay, Fred Nazem asked a question. What's the average relative ownership post-SPAC between the company, the sponsors, and the market? Are there any guidelines on that or thoughts?
It totally depends on the size of the partner company relative to the size of the SPAC IPO. There's no way to gauge it without knowing those 2 numbers.
And the size of the pipe. But what's important to note is just the promote structure going in is typically 20% regardless of the value of the transaction, assuming the share price maintains a certain VWAP over a certain period. But that does get renegotiated often upon merger agreement.
Well,
and
questions?
I have one more question, Milt,
Sure.
So the speed and of flexibility of SPAC seems to be pretty strong in terms of like the ability to adapt to the marketplace. I mean, you see it being used for all. I mean, WeWorks is pretty distinct from purchasing a software as a service company, right? So there seems to be a lot of flexibility and adaptability in the SPAC model. What do you guys see as a force that can derail it outside of regulatory? Anything that you guys see that could derail this momentum that the SPAC market has?
Well, I think regulatory is certainly one. And, for those that don't know, the FCC has proposed some changes in the way SPACs do some financial reporting. And that's, thrown the market into a little bit of disarray while everybody sorts that out. And hopefully for everybody, SPACs, the investors, the regulators, everybody will get it sorted out quickly. But, I think the idea that somebody threw out before, bad deals, right? If the SPAC market works because we're sort of self-policing, I mean, you can have regulation and such, but we all want to do a good deal. We want that stock to trade well. And then we want people to say, well, those were good partners. I want to do my next deal with them, right? You have a bunch of serial SPACers or soon to be serial SPACers on this panel. And so if weak SPAC teams do weak deals and they trade badly, then it's going to make companies less excited about merging with SPACs, and that will hurt the market overall.
So, hey, Milt, I got to tell you, I mean, when I saw your preparation for this panel, I was like, this is really great preparation, but it's easily surpassed by how well you've run this panel. I mean, this has got to be the tightest panel that we've run in years. Just boom, boom, boom. Really fantastic. You guys hit all your points. I'm very impressed. And as you guys know, we're going to be back in Silicon Valley in May, and some of you guys were on the Silicon Valley panel last time on SPAC, so you're welcome to come again.
Marty, let me just say one thing for the panelists. Thank you all for participating. Don't forget to put your contact information available to the public.